Welcome to the daily update, where I'll go over the action in the market for Friday, November 22nd, and we'll see how things look for Monday, November 25th. Yeah, looking more solid now. A lot of our indicators are turning more positive. We never did go negative when you base things around the moving averages. We stayed above the 20-period moving average, but our smart money indicators and some of our internal measures of the S&P are showing some improvement. What we're seeing that's a little bit different now is the large caps and the mega caps, they're not leading things higher. They're actually probably underperforming to the point where they're not really helping the indexes to shoot higher. But this is more positive in that we're seeing more broad-based participation, not only with the other stocks in the S&P, but across the NYSE as well. Before I get started, please feel free to check out the SPX Investing Program. It's a program I've developed. It's free until the end of 2024. There's a link that'll take you to the website or to a video. If you have any questions, you can email me. One of the benefits is that you get access to all the videos that I upload immediately, where they are delayed on YouTube and Rumble. Also, the daily video, that's where I really focus on things. All the other videos around the outside that I'll be preparing over the weekend, those are meant to feed into the daily video. Okay, let's go back and talk about what happened and look at some charts. We did have kind of a slightly higher open. The futures were pretty much flat, but we went up right after the open, and prices were pretty choppy, but we stayed positive. We were above the unchanged level. Then we continued to stay positive. We didn't get all the way up to R1 at 59.79, and then we ended up closing slightly below the intraday high. So in that aspect, we didn't see any real conviction, but we stayed positive. We were up 0.35% on below average volume. So kind of a slow day. And in the upcoming week, the market will be closed on Thursday for Thanksgiving. It'll be an abbreviated day on Friday. Expect volume to be below average, but there's always exceptions to that if something really develops. But this is pretty much treated as a holiday week. They like to keep the market open so the market can react to whatever happens. But a lot of folks are probably taking the entire week off. So we'll usually see a real drop off in the volume, maybe Monday or Tuesday. Now, Wednesday, we're going to have major economic, I shouldn't say economic reports, but a very long list because everything that comes out on Thursday is coming out on Wednesday. Nothing too dramatic. There's no employment situation report or CPI or PPI, anything like that. But there's going to be a pretty long list on Wednesday. There may be some reaction to that. So we are positive in the short, intermediate, and long term. Interest rates, they're chopping around right now, so they're not really causing any more concerns for stocks, but they're not really dropping lower at the same time. Of course, with the holiday week coming up, we want to keep an eye on geopolitical things, not only in the US, any kind of what's happening after the election, but what's going on between Russia, Ukraine, Iran, Israel, and those things, because they could always escalate and have some kind of an impact, whether it's more of a news type thing or is it going to actually directly impact the market itself. So mega caps and growth, they continue to underperform. You can see this is negative because a large part of the run up that we've seen since October 2022, when we really bottomed and started to come up out of that, was being led by the mega caps and growth. Well, they're not doing as good right now. They're not falling apart. They're just not leading things the way they were before. We're seeing more broad market participation. Now, if they kick into gear and the mega caps and growth stocks really start to do well, that's just going to shoot us even higher. We do have a non-confirmed Hindenburg-Ullman, and I'll go through that near the end of the video. We're just waiting to see if a confirmation is going to happen. And we have a couple of things now in our short-term list. The Williams percent R, which is a short-term indicator suggesting good momentum in the short term, and our short-term stochastics are also starting to get extreme as well. And we still have the Sean trend meter, which never did come off of the list. For a few days, it was the only thing that was on our list in the intermediate term. And we're still above that 150 and 200-day simple moving average line that I put on the chart, which could also suggest good long-term momentum. And that's pretty much what we've been seeing throughout 2024. No changes to the current scenario. There is some concern that these economic reports are stronger than expected, and that could really raise doubts about the Fed cutting rates at their next meeting. The dollar was up and interest rates were down. So we were at 4.41% with the 10-year yield, where we had been at 4.43%. And we're still inverted with the 10 to the 3 month, but we're no longer inverted with the 10 to the 2 year. We're just kind of waiting to see if things are going to go back to normal. And I can finally, after 2.5 years, take these things off of the list here. Sentiment is positive. We did tick up a few notches. We're at 61, where we had been at 58. When we get up to 75, that's where we start to get a little overly optimistic concerning sentiment. And we're still not trending. The ADX is still below 20. It's still below its moving average, but we are positive. The green line is above the red line. And with the up day, the bias is positive, and I'm changing our momentum mix to positive. And I like to explain this from time to time. I try not to put opinions into this video. I try to let the charts just speak for themselves. That's why I try to point out positive and negative things inside of the same chart. The bias, that's a little more me, okay? A few days ago, we had an update, but I called it mixed because it didn't look really strong internally. The momentum, that's also me. And these are really the only subjective parts of the video that I focus on. Everything else, I try to be more objective. So we're still mixed to positive. We are looking more positive, but we would like to see growth in the mega caps doing better. All right, the economic reports. We did get the global U.S. manufacturing PMI. The preliminary reading came in at 48.8. That's under 50. So that's showing contraction, where last time it was at 48.5. The services PMI is above 50 at 57. That's showing expansion, where last time we saw 55. And I don't have charts to show this. They don't really have that much of an impact. Consumer sentiment, which I do have a couple of charts to show, it came in at 71.8. It was down from the 73 that we saw last time. And so looking at these charts, well, first of all, we'll go through the Isabel Net blog charts here, where this is put up by Real Investment Advice, and they're just saying, okay, can we continue on what we've been doing here, where we have the in red, this is the S&P itself, and then cumulative real GDP growth, that's the black line. I mean, we're growing, but look how far away we're getting from this line, and the cumulative S&P 500 sales and growth. Again, getting far away from this. And some folks have concern over this, and longer term, yeah, that would be a concern. But you can see that we've been in this state now for years, so it doesn't necessarily have much of a short-term impact on things. Then looking at the cumulative sector flows going back to 2014, where we're seeing money still really going into tech. That's the big area, and that's why we focus on that, and that's growth, and the mega caps are in that area as well. And then the stretched valuation in the U.S. equity market is reflected across modes, standard deviation metrics. The takeaway from this is, yeah, I go over this in the intermarket analysis video on the weekend. We're overvalued historically and even looking forward, but we've been that way now for quite a while. And no matter how you look at it, the different types of calculations that are done, yeah, the market's overvalued, but it just doesn't seem to care right now because earnings are still growing when we look forward. And then the 31% of large cap mutual funds are outperforming their benchmark. Now, a lot of this is the benchmark could be the S&P 500. So you have 31% that are outperforming. Okay. That means 69% are underperforming. And that's why when we get into good, solid bull markets like we've been in since October of 2022, it's better to get into index funds, which they thought were a joke when they first came out in the 70s by John Bogle. because most mutual fund managers can't outperform the indexes. So you might as well just go with the indexes. Now, when we hit difficult times, like in 2022, yeah, then the mutual funds that are managed, they tend to do better because those managers have more, flexibility with what they can do, where the indexes are just getting taken down with everything else. All right, total returns for a selection of major global financial assets since the election. This you might want to pause and look at this, but the Nasdaq and the S&P have been doing the best, where there's a lot of other assets that are actually going down since that time. And then cumulative flows into US government, these are money market funds, where we're seeing a lot of money going into money markets. And again, this is not necessarily a parking place to go into the stock market. It's because money markets are giving a better return than what we're seeing in banks. And then the net yields are actually going down here. And then easing inflation has helped push the correlation between stocks and yields higher. And we're seeing that as interest rates have been going up, stocks have been going up for the most part too. Usually they tend to go in opposite directions, but they're tending to look at this more as okay, interest rates are going up because the economy is looking better now. And so it's okay if they tend to move with each other. All right, don't have any charts. Here is the chart of consumer sentiment, where this breaks it out in three different areas. First, we have the blue line, which is improving overall. That's the total reading. And then the present, how they're feeling not so good right now. Maybe, this nuclear war possibility might be getting on folks. Maybe they're a little down about Thanksgiving coming up or something. But looking out into the future, the yellow line, they are looking more positive about things here. And then I plot this chart. The blue line, that's the consumer sentiment here. And it really had dropped off, but it's showing some improvement, even though it was down from the previous reading. And then just to give it a little bit more context, here's the 2-year treasury yield, which has also been coming back up. And this could also be that they're looking at economic strength going forward. I looked at Twitter, but didn't find everything's about Bitcoin. Is it going to hit 100,000? And some billionaire guys going to jail for a long time, and that doesn't really apply to what we're trying to do here. So here's the intraday chart. Pretty, really choppy day where we looked to actually open a little bit lower, but then immediately went higher. That's why I said we had a higher open. And we came up, came down. The unchanged level was acting as a built-in support level. We never did really go negative other than just for a very short period of time. And just kind of chopped sideways, saw a little bit of strength near the end of the day and closed just a little bit off of the intraday high. And not much of a change as things closed down for the weekend, but in the initial overnight session, we were down just a little bit. Things got quite a bit more negative, and then they clawed their way back as we were getting ready to open. So Europe is kind of acting strange right now as far as their stock market. They act strange in other ways too, but they're just they're not really correlating with what we're seeing in the US right now as far as how the European stocks are behaving compared to the US stocks. But we saw the futures really coming back and repair some of their overnight losses, and then we ended up having the up day. This is a little bit of a concern, but it could also be positive as well, in that the red line is going up and it was positive. That's value. Now, typically, when the market really goes up higher, it's when the blue line is above the red line. And we've seen for the last few sessions now where the red line's back above the blue line. The blue line was actually down where the red line was up. And not really seeing much of an improvement here with S&P growth to value. We're actually coming back down to levels that we were at around Halloween. And then things were looking a lot better. And then we've been just we had a couple of good days in here, but we've been dropping off as value's been underperforming. Growth has been underperforming value. So on an end of day basis, growth was actually down where value was up pretty solid. It was up a little bit more with the mid caps and but up less for the small caps. So this is looking better, but we're still in a downtrend when we look at small cap growth to value. Mid cap growth to value still in a downtrend, but showing some improvement and kind of going sideways, but in an uptrend still, with S&P growth of value. This is the one that we pay attention to for how it will impact the S&P. And coming down into the top end of the rainbow here when we look at the growth versus value ETF. But discretionary to staples, looking pretty solid here in an uptrend. That's kind of a proxy growth area as well. So that's looking good. Large cap growth was up, but not back to setting an all-time high at least yet, but still looking pretty solid. As far as our trend, we're still below 20 with the black line. That's the ADX, and we're below the moving average. So we're in a weakening trend, and we're not even in a trend right now, a weakening, non-trending environment. But we are positive because the green line is above the red line. In the short term, green line above the red line, also not trending. So short and intermediate term, we're currently in a non-trending environment. And volume was below average. You can see the oscillator has been coming down lately, and it might continue to drop as we go into next week. We did decline with the VIX on a closing basis by looking at the line chart as well as the bar chart. And the VIX of the VIX also comes down when the VIX goes down as well. We're dropping below the moving averages with both. So we were starting to go back up as far as the momentum is measured by the MACD, but now we're right on top of the moving average. If we continue to go down with the VIX, the momentum will probably continue to go down as well, which is more positive for stocks. This is the tendency of the seasonal chart here that we should continue for the most part, not straight down, but continue to decline going into the end of 2024, which means that stocks would be going up. Now we're still getting a signal here with the skew index, which is a variation of the VIX. Coming up into this red area, a little higher up than where we were at after Thursday. So the market is still expecting some kind of a big move that hasn't happened at least yet. But we don't know if that's going to be an up or down move. You can look at the arrows that I have here. Sometimes it was a top, sometimes a bottom, sometimes just a continuation. And we're seeing a little bit more conformity here. We were down just a little bit with this fear gauge, and we're also down with the other fear gauge, where they have been conflicting each other recently. We did decline with the equity put call ratio on the daily chart, and we're going back down with the 5-day chart, and now we're starting to ever so slightly turn back down with the 10-day chart. So now these are starting to confirm each other, a little shorter and longer term when we look at the ratio between puts and calls. And still coming to the lower end of this band here with the volatility risk premium. So we're seeing not a lot of risk being perceived in the market right now. And we are looking pretty good here. We're actually just about, looks like we just barely set a new all-time high here with the advanced decline line, which could be positive because we've not set a new high yet based on price. So this could be just suggesting that more stocks are participating and that this is really breaking up. And volume, we did set a new all-time high. So this could be taken as positive as well, even though we haven't really seen that reflected in the S&P itself. Starting to see an expansion of the new highs. In fact, after really dropping off here with the 5-day moving average, we're starting to turn back up. We're also going back up with the 10-day moving average here. So this is another internal measure that's looking pretty strong currently. And we're above zero and going up with the advanced decline ratios, the 19-day and 39-day. We're positive with accumulation distribution. We're above the moving average now. So that's looking pretty good from a smart money perspective here. We're also turning positive with the chicken money flow. This had been a concern as we were going sideways and the red line was still going down. Well, the red line was starting to come back up and we've gone from red to green now. So this smart money indicator is also positive. And we're also positive here with the chicken oscillator. So that's looking better internally for the market. The vortex has the green line going up and the red line going down. And we're not quite back to setting a new high here with the cumulative advanced decline line for the S&P, but we are setting another new high based on volume. So that volume is leading price. That's positive. And we're actually seeing the advanced decline line going up and a little bit outperforming right now when compared to the S&P 500. Now, these are two different things, the advanced decline line and the S&P, but you can see over time how they tend to really match up with each other. And sometimes they get out of line. This is when just a few stocks were really leading things higher in June and into July, where the red line was kind of going sideways. Now they're more matched up, and this just suggests more stocks are participating. And looking pretty good here with the NYSE cumulative advanced decline line. Breaking out here and setting a new all-time high, crossing back above the moving average with the regular NYSE advanced decline line, also above the moving average with this other NYSE advanced decline line, and not setting a new high with the NYSE common stock based on price, but setting a new high based on volume. That could be positive if volume is actually leading price. And our advanced decline line looking much better now. The NYSE common stock breaking out above the moving average, as is the S&P, the mid caps, and the small caps. And this had been turning negative. This is a broad market measure of the 5-day moving average of the highs minus the lows. We dropped below zero. Now we're starting to come back up. So this is also showing the broad market looking stronger. And we're going up with those stocks above their 20-day moving averages in the S&P, enough to get above 70 now. When we get above 70, that's usually showing good short-term momentum. And we're also going up with the 50-period moving average study, the 100-period moving average study, and the 200-period moving average study. So we're coming back up right about to this pivot point here, which may be acting as overhead resistance. That's just about where we closed. I know it's hard to see with this big P in here, but I want to leave these pivot points on here for the time being. We did drop to below average with volume. So we're improving with the 20, 50, and 200-day moving averages. We actually came down a little bit with the Stochk RSI, but we're still above the midpoint, or we're starting to show good momentum here in the short term with the Williams percent R. We're bouncing up from the midpoint with the CCI 14 and the CCI 20. In the short term, the stochastics. Now, this is a further subdivision of the short-term time frame. So a short term, getting a little extreme here, but still looking positive. Looking positive in the intermediate short term, starting to turn back up, but still more negative in the long short term. And the force index starting to cross back above the midpoint. That's turning more short-term positive. And we're coming right back up to the green line and the blue line here with our short-term evaluation of the trend itself. This is a double and triple exponential moving average study. If we could get above this and see the lines continue to go back up, that will be more positive in the short term. And we're still looking good here with the simple and exponential moving averages based on 20 periods. Getting into the +2 channel, we're not extreme here with the standard deviations chart. We're above the midpoint. This is still looking positive. Intermediate term, going up with the balance of power, that's positive. Coming back up, closing just a little bit above the red line here with the intermediate term trend evaluation. That's a double and triple exponential moving average based on 50 periods. And positive with the go, no go with the dark blue bars, above the midpoint with the highest high value. Still looking more positive with the lighter blue bars with the TTM squeeze, going up with the ease of movement. That's positive. Still flat with the Arun, but above zero. So that's still positive there. And seeing a real improvement here with the S&P McClellan oscillator. Further advances above zero here with the S&P itself. So we're going back up with the summation index based on price and volume. That's going from negative to positive, and it's been positive for a few days now. Also on a broader market measure, the NYSE McClellan oscillator above zero and advancing. So turning back up, it's really hard to see, but it is happening with the NYSE summation index based on price and volume. And we're back to positive here with the Swenlin trading oscillator based on price and volume. Both are above zero. Momentum still takes a little bit of time for this to catch up here. Kind of trying to turn back up with the PMO. We're turning back positive, though. If we break it out based on price, we're coming right up to the moving average based on volume. So looking pretty good with the PMOs that are rising. And this is another measure because these are all of the PMO signals that are going up inside of the S&P. And so this going up, that means there's a lot of stocks in there that are doing that. We're also seeing the buy signals going up, and we're starting to turn back up with the PMOs that are above zero. The slope oscillator, again, these tend to lag a little bit here. Even the short-term one, we're still looking positive, and we're still slightly above the moving average here in our short-term slope oscillator picture. Turning back up, it's still negative with the MACD. So still kind of flat here with the slope, trying to turn back up with the TSI. Those are the two short-term oscillators. Improving here with the MACD, the PMO, and PPO. where we never really did go negative in the long term with the Trix and KST. The Trix is coming down to its moving average. The KST is still positive. And rolling over just a little bit, but still above its moving average with the Copic curve. Another momentum oscillator. And here's the Sean trend meter going back up, not necessarily really extreme. And we're positive with the ultimate oscillator as well as the money flow. So we're seeing confirmation here on balanced volume above an advancing moving average. That's positive above all the plotted moving averages here, which is never really turned negative recently. And this is a Pring bottom fisher. It's supposed to pick out after we really come down, which we didn't do this time. But this is generating a signal anyway, so I wanted to show this chart. This could end up being positive if it's a valid signal. And we're still looking positive with the RSI 14 and RSI 9. We're above 50 with both. That's suggesting short and intermediate term solid momentum. Still positive with the parabolic SAR. We're positive with the Elder's Impulse system for the S&P. And we're going back up again here with the bullish percent index. So that's turning back more positive. We're also going back up with the NYSE bullish percent index and the NASDAQ 100 bullish percent index. So we're seeing confirmation there. I didn't pick out any support or resistance now because we're above the short-term support that we had been following. And we're looking more positive here with the Heikin-Ashi chart with the open candles. We're also pointing back up with the Kegi chart. We're positive with the Renko chart, but we're still looking a little more negative with the three-line break. It hasn't picked up this positive movement, at least yet. Long term, we're getting above this red line with the 150 and 200 period moving averages. So that's suggesting good long-term momentum. And if you look, here's last spring, and then we had the day that the world was supposed to end last August. We've spent most of 2024 above these red lines with both of these moving averages. So we're still positive across the board on all time frames with the different indexes. Haven't seen a change here where we're still negative with bonds in the short and intermediate term, positive with commodities in the short term, and now the dollar is in a full-fledged uptrend according to this measurement here. And we only had communication, which is a growth area, that ended up being down, and utilities were down, but discretionary led things higher, and that's kind of a growth area that we like to see. We would like tech, it was virtually unchanged, but we would like to see that doing better. And awful lot of green here, just one red, and that's actually considered positive. The euro set a 52-week low against the dollar, where Canada is just having just party times here, with the dollar setting a 2-year high here. We got above 19,000 with the NASDAQ. The Dow was above 44,000. We had staples have a BPI cross above 50. That's turning a little more positive. That's a little bit of a concern here because that's more of a defensive sector. And to have it doing well, I mean, it's okay for it to do well, but at the same time, if it really starts to outperform, that could mean the market's getting more defensive there. But we like how discretionary is having a BPI cross above 70. Good, solid momentum that way. And with the equal weight, the red line's going above the S&P itself. That's, again, just suggesting the rest of the S&P is outperforming the big stocks. The Dow not back to an all-time high yet, but it was up almost 1%. Looking positive with the Elder's Impulse system for the diamonds, and still not really showing a lot of strength here with the NASDAQ, but it was up, but only up 0.16%. And we were up 0.17% with the NASDAQ 100. So these are the areas that typically do well when we're really screaming higher. It's not that they're doing bad. It's just we would like at some point to see these really kick back in to take things higher if that's what ends up happening. The Qs remain positive with the Elder's Impulse system, but the momentum for the NASDAQ 100 is still negative. It's going to take a little bit of time for the PPO to cross back over positive. Small caps up 1.68%. This was one of the better areas of the market. And we look at the Russell 2000 small caps, looking good with the RSI, trying to turn back up and go positive with the momentum. And we're positive with the Elder's Impulse system for the small caps. We're also positive with the mid caps here. And the mid caps setting a new all-time high here as well. The Wilshire, not back to an all-time high yet, but up over 0.5%, looking solid there. up 0.47% with the total US stock ETF. This is, again, is just suggesting we're seeing across the board strength right now. Financial sector is setting a new all-time high. The FANG index was barely up, but still looking positive there. Still below the short-term trend line, still above the longer-term trend line with the FANG index. Apple was up 0.59%, trying to get up above its 50-day moving average. Amazon was down 0.64%, but still above its 50-day moving average. Microsoft was up 1%, still has not generated a death cross yet here. It's kind of trying to fight it out to see what will happen. Google is still under pressure over possibly having to sell Chrome and maybe Android and regulatory issues there. So it's coming all the way down to its 200-day moving average. And so far that has held. Nvidia was down 3.22% after just giving a really good earnings report. Meta was down 0.7%, still under its 50-day moving average. Tesla was up 3.8%, still looking pretty solid there. And just barely setting another new all-time high with Netflix, but it was up only 0.03%. Still seeing an improvement when we compare US to world stocks here in the short term. Still seeing a longer term deterioration with that correlation there. Going up a little bit, but not really bouncing around all that much. We're into the 71 range now with oil, and we're really watching this for geopolitical reasons. The dollar is just getting up into the mid 107s now. The longer we stay up here, we could be seeing a golden cross here with the way that I measure trends on this chart. But that's just looking really solid. And if you want to go to Europe, you want to go to England, you want to go to Japan, you're going to get a pretty favorable exchange rate. We did come down with the 10-year yield, and we were up with the 10-year based on price. And not really seeing much here. Growth is not showing a lot of strength when we look at the Qs to S&P, still under the moving average. We are seeing discretionary doing quite well and above an advancing moving average. We're dropping below the moving average when we compare large cap growth to large cap value. So the large caps are actually underperforming right now, where we're seeing more of an improvement with the mid caps and the small caps. So what's our outlook for Monday? We are positive, and there is positive seasonality. Now, that's not a given. It doesn't mean that we're naturally going to go up. It's just things tend to be more positive, especially as we finish out the month of November. We don't have any economic reports coming out on Monday, and we want to keep an eye on all the different geopolitical things in case they have an impact on the market. Here is the economic calendar for the next week. You can see the really long list for Wednesday. We have nothing on Monday, a few real estate type things on Tuesday, and then consumer confidence. And then we'll be closed on Thursday, and we're just going to get Chicago PMI on Friday. And here's also another look giving you what the previous readings were. And then seasonality. We are positive for November 25th. We're up with the Dow, S&P, and NASDAQ. We're beyond the week after options expiration now. And again, I'm not sure if this is all that useful. It says stocks do better under re-elected presidents early in their second terms. Well, we kind of are dealing with a unique situation here that hasn't happened since Grover Cleveland, when he was president, then not president for 4 years, then came back and was president again. Kind of that same thing here. And so it's not a real solid comparison with, okay, because Trump is reelected. He just didn't serve 2 consecutive terms here. All right, then looking between Thanksgiving and the second day of the new year, we do have positive seasonality with the S&P and with the small caps. They call this the Santa Claus rally. And we do see some positive seasonality from Monday's session here, even during an election year. Also, once we get beyond this is the 23rd. Well, that's a Saturday. So by the time things come back on the 25th for Monday, according to the Carson chart here, we do have some positive seasonality this way. Monday is the most solid day of the week in 2023. It's up, but not up as much in 2024 so far. And we're back into that period of time, according to Tom Bowley's research, where from now until the end of the month, we tend to see positive seasonality that way too. And then this is just showing after the election, positive seasonality in this chart and in this chart as well. So, what are the warning signs? We're still not really seeing our oscillators click over and become positive. They're improving, but they're still negative when taken together. The Copic curve is still positive, but it hasn't quite started to turn up yet. And actually, this should be down. The equity put call ratio on 10 days, that's back to going down now. And we're still seeing an improvement with the NASDAQ 100, but the momentum continues to be down. And we have a non-confirmed Hindenburg-Ullman. That's on the warning side here because Hindenburg, the humanity with the Zeppelin blowing up there. That's why they call it that. Okay, and then looking at the positive side, we are seeing a real improvement with our smart money indicators across the board, and that's encouraging. We're seeing the S&P and NYC McClellan oscillators, they've turned positive, so the summation indexes are now going back up. The Swenlin trading oscillator, and the reason I have this in yellow instead of gold, if it's gold, that's a primary indicator. Yellow means it's kind of in between, a primary and a secondary indicator. And the vortex, that's also a primary indicator. It is positive. And the equity put call ratio for 5-day and the 10-day should also be on here. That tends to be more positive when those are going down. Now, the growth of value, it's been underperforming, and discretionary is doing a little bit better right now, but we want to see this come through a little more than it has been. The advanced decline lines are looking good, and our moving average studies are looking good. The parabolic SAR is positive. The bullish percent indexes for the three indexes that we follow are positive and going back up. The ease of movement, the money flow is positive. The ultimate oscillator, and then way down at the bottom, you can't quite see it. It's the financial sector. Just take my word for it. It's positive. And then here's the Hindenburg Ullman. If you want to read through this, please feel free to pause this and just read through it. But what I use is an indicator that was developed by stockcharts.com where it takes all that criteria together. We did get the initial spike on November 20th. Now we're waiting to see if we get another spike, and that needs to happen. We have until December 19th for that to unfold. So the conclusion, we're still positive. We're not trending in the short and intermediate term, even though we are positive there. And we're in a period of positive seasonality, but we're seeing some signs of improvement. And in the short term, we also have an improvement with positive seasonality. We're also not trending, but we're positive that way. And in the intermediate term, let's see, short term, intermediate term, and then long term, we continue to be positive there. Thank you. I hope you have a really nice weekend, and I will talk to you in the next video.